Hello everyone, this is Brad McMahon with Trader Trading Headquarters. You are watching our free educational video series for traders and investors. All we ask in return is that if you like the video, like it, and if you really like it, share it with a friend. The double top reversal is a bearish reversal pattern typically found on bar charts, line charts, and candlestick charts. As the name implies, the pattern is made up of two consecutive peaks that are roughly equal, with a moderate dip in between. Although there are variations, the classic double top reversal signals at least an intermediate change, if not a long-term change, in the trend from a bullish to a bearish. Now, many potential double top reversals can form along the way, but until key support is broken, a reversal cannot be confirmed. Now, to help clarify, we'll look at some key points in the formation and then walk through an example on Ford Motor Company. So with any reversal pattern, there must be an existing trend to reverse. In the case of the double top reversal, a significant uptrend of several months should be in place. Now, the first peak should mark the highest point of the current trend. As such, the first peak is fairly normal and the uptrend is not in jeopardy, or at least it's not in question at this time. At this point, we're going to form a trough or a dip. After the first peak, a decline takes place that typically ranges from about 10 to 20%. Now, don't worry about the volume on this decline from the first peak. The lows are sometimes rounded or drawn out a bit, which can be a sign of weak demand. At this point, the second peak forms. The price will advance off the lows, but this time under lower volume. It will then meet with resistance from the previous high. Now, this resistance from the previous high should be expected. Even after meeting resistance, only the possibility of a double top reversal exists. The pattern will still need to be confirmed, and the time period between peaks can vary from a few weeks to many months. And the normal is about 1 to 3 months. While the exact peaks are preferable, there is some leeway. Usually a peak within 3% of the previous high is adequate enough. Now we'll want to see a decline from the peak, and we should see an expansion in volume or an accelerated descent. Now, a decline like this shows that demand is weaker than supply and the price is looking for some type of support. Even after trading down to support, the double top reversal and trend reversal are still not complete. Breaking support from the lowest point between the peaks completes the double top reversal. This too should occur when an increase in volume and/or an accelerated descent. Now remember, in most chart patterns, support turns into resistance. Broken support becomes potential resistance, and there is sometimes a test of this newfound resistance level with a reaction rally. Now this test can offer a second chance to exit a position or initiate a short position. At this point, we want to calculate our price target. The distance from the support break to the peak can be subtracted from the support break for a price target. This should infer that the bigger the formation is, the larger the potential decline. Now, the double top reversal formation may seem pretty straightforward, but technicians should take proper steps to avoid a false reversal. One way to confirm this is to make sure the peaks are separated by about at least a month. If the peaks are too close, they could just represent normal resistance rather than a lasting change in the supply or demand. Ensure that the low between the peaks declines at least 10%. Now, the declines less than 10% may not be indicative of a significant increase in selling pressure. After the decline, analyze the trough for clues of the strength in demand. If the trough drags on a bit and has trouble moving back up, demand could be drying up. When the security doesn't advance, look for a contraction in volume as a further indication of weakening demand. Perhaps the most important aspect of the double top reversal is to avoid jumping the gun. Wait for the support to be broken in a convincing manner, and usually with an expansion of volume. A price or a time filter can be applied to differentiate between valid and false support breakouts. We want proof that the trend has broken, and one way to do this is to set your stop limit order 10 to 11 cents below the support. Until support is broken in a convincing manner, the trend remains up. Thanks for watching the video on the double top reversal pattern. If you like this video and would like to learn more about stock charts and patterns, visit our website at tradertraininghq.com. Here you will find lots of information on trading the markets. Go to our training tab and you'll find free courses, articles, TradingView charts, watch lists, trade examples, books, and even a chat room. If you'd like to get a feel for our membership benefits, fill out this information here and create a password, and you'll get access to more free lessons. The free lessons include simpler stock trading for beginners, candlestick patterns, chart patterns, free introduction videos, webinars, and a trading community where you can access all of our social media links. Please take a moment to read our disclaimer. The information provided herein is our opinions only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.